My name is Jay Norris. I'm the Director of Education at Trading University. Thanks for attending. As always, we need to put a disclaimer on it. Trading Forex is a risky endeavor and not suitable for all investors. That really is so, not all of us are that calm and that collective about it. You have to understand the seriousness of that disclaimer, and not to say that you can't change, but, it is a very serious business. Money's a very serious business. Any industry, I always say, that encourages the use of a simulator, you need to take serious. In addition, the techniques I demonstrate here are proprietary and should not be retaught or retransmitted in any way. I'm sure that doesn't apply to you. That really only for someone that would want to take what we teach and put it in their webinar and try to gain some kind of commercial edge with what we're doing. That's not fair to our students. It's not fair to us, right? My name is Jay Norris. I'm a 20-year trading floor veteran of the Chicago Board of Trade, which is to say, I survived 20 years down there. Definitely learned a lot about the psychology of trading. That was a whole different age, though. I think we have it so much better now with the screen trading. We have access to so much more information than we did back then. Your charts are a lot better. Your charts are free, essentially. I pay, I think, $70 a month for e-signal. Back in the day, charts used to cost us $600. Yeah, you had to pay for the exchange fees. Out in Forex, I mean, you get it free, so that's even better, right? It's like free beer, right? Can't beat it. I've also written a couple of books on trading, which were published by McGraw-Hill and which serve as the textbooks for the courses. What's unique about these books is that they include trading plans, so you can go see. You can go back test the information we provide and see the validity of it. Transparency, very important for all of us. The technique we're going to demonstrate today is highlighted in this second book, that book on the right, Mastering Trade Selection and Management. As I said, my name is Jay Norris. Here's my contact information. If we don't get to your question or for whatever reason you want that, you can go ahead and email me anytime, and there's my Skype information also. Look forward to hearing from you. I'm big on trading method. You guys that have sat to my webinars in the past, you know that you have to have a solid trading method behind you that's going to complement you. You're the one in the driver's seat. There's no ifs, ands, buts about that. You're driving the car, but you have to follow the rules of the road. So you have to have a handbook. You have to definitely have a method that you're going to use, and that's going to complement you, complement your own intuition. So before I get into trade selection, how we can help you with trade selection, a few words on methodology. The first thing you need to know is if you're going to be successful, you have to have a robust trading method which works in all environments. It's going to help you identify whether you're in a trending environment. It's going to tell you no ifs, ands, buts about it. You're in a counter-trending environment. That's very important for you also. You need to know whether the markets are coordinated. Currently you're in a funny market because the majority of patterns are down in the euro, but they're up in the Aussie. If there's one thing I can guarantee it, you're not going to see a big move. You're not going to see a market rip off a 6, 8, 10, 100 pip move when the markets are in flux like that. So you have to know not just whether the individual market's in a trending or a counter-trending environment, but overall whether the groups of market are coordinated or not. That's very important for us. So trading environment, identifying what type of environment you're in is going to help you tremendously, and it's going to help you. There are times, I hate to admit it, but there are times where you shouldn't be trading. The environment's going to give that to you. Friday, a lot of times on a Friday, if you're in a counter-trending market on a Friday, you shouldn't be trading. Today, the last 2 days is actually one of those environments where if everything's slow, if they shut down the stock market, let's face it, if the bond market and the stock market are closed, you're in a holiday market. You really got to give that serious consideration. So you have to be aware of the environment you're in. It took me over 4 years to put together a trading course that teaches an objective empirical method that's going to help you identify all those different trading environments, meaning up markets, down markets, sideways markets, slow markets, fast markets. So regardless of shifting fundamental conditions, regardless of the day-to-day news flow, what's going to give me peace of mind as a trader is have that robust method. Know with definition, know absolutely that you know what environment you're in. And even if it's an environment like today, hey, you're in a holiday market whether you like it or not. That's a very difficult that's a difficult time to be short anything. There's an old market saying, very good saying, don't get caught short in a quiet market. So if anything, I'd be favoring markets that are in uptrends already. I'd be looking to buy dips and uptrends when you get in a slow market like that. We just saw it in the euro too. The euro got to a level that normally that's going to prove to be resistance, looked like a pretty good sell signal, and then pow, man, they would have kicked you in the head if you were short that market. So you have to know what environment you're in. Yeah, if you're going to trade, you absolutely need a method for all seasons. And that method better be simple. It better be easily explained. I said it took me 4 years to come up with the method. As simple as it is, it did take me a long time because primarily I had to make sure that method worked in all different environments. It starts out you better be good in a trending market, but at the same time you better be good in a counter trending market. So you need a method that's going to apply to both, and there's going to be different ways to manage your trades too in both. So you better have a simple method. Our method's based essentially on chaos theory. It's based on fractal geometry. I know that sounds like a mouthful, but it's really pretty simple. So as I said, easily explained. You better be able to know what studies your method's based on, or if someone's teaching you their method, they better be able to explain it to you pretty simple. I've got it down to one sentence. Here's our method, and this goes for actually. This would be when we're gauging, when we're position trading. This would be for long-term trading. We focus on markets with low non-systemic risk, i.e. currency markets, and look to trade at those times when the day-to-day news flow is aligned with the primary or secondary patterns. Very important that you understand what that day-to-day news flow is. Also, we call it the day-to-day pattern. Currently in the euro, your day-to-day news flow is aligned with the secondary pattern, and it's counter to the primary pattern. So that may or may not, that's not going to be the best market to rip off big moves. That's going to be a market that's essentially counter-trending that you're going to have to settle for smaller moves. So you're going to have to manage your trades a little bit different in that environment. So currently, the euro, the day-to-day is counter to the primary and the secondary. The opposite is true in the Aussie, and we could show you that too, where currently in the Aussie, the day-to-day pattern, the day-to-day news flow in the Aussie is down, yet the primary and the secondary are up. So you're in a counter-trading environment. You better know that. Okay. The beautiful thing about all the currencies is, and trading overall, as far as stock indices, exchange-traded physicals also on the exchanges, those are great products too because they're low. They have low non-systemic risk. The beautiful thing about the wide array of markets that we have access to is that you're generally going to be able to find a market where the patterns are aligned and you have a positive environment or a negative environment. I don't care if I'm long or short. From my perspective, there is only the right side of the market. There's not two sides of the market. There's only the right side of the market, and I don't care whether I'm long or short. I just want to be on the right side of the market. So that's how we've described our method as a position trader. Here we go as a day trader. We focus on markets with low non-systemic risk and look to trade at those times when the micro patterns are aligned with the day-to-day news flow. Or we can even take advantage of counter-trending micro patterns also. You don't want to do that. It's an option though, and every now and again you're in the right environment for it, i.e. late in the week, late Thursday or Friday. That's the time you go counter-trend. But for the most part, you'll always be able to find something to do when you have the micro patterns aligned with that day-to-day news flow. Day-to-day news flow, very important for us. Now, that's, even when you have everything aligned, again, if you're in an environment like today where it's a dead market, it's a holiday market, basically, and there's nobody out there, you got to be real careful trying to sell. You want to be real careful trying to short a quiet market. And, these are things we do teach, and they definitely are teachable And that's another reason why I insist that we teach in live markets. That's the only way you're going to learn. That's, it's very true. When you teach, you learn twice. I've learned so much because my neck is always stuck out. I'm always teaching in live markets. We're always highlighting signals and setups in live markets, and that's the way to go. It's just priceless information that you learn from that. Usually I don't talk about what does not work. You won't hear me talking about negatives. I'm just going to focus on what works. I really don't care what other people do. I'm going to show my students what does work. So I think it's very important that you focus on what's going to make you successful. However, I think to transition to that point, to get to that point where you understand why we only focus on positives and get you to focus only on the positive, I think it is appropriate if you're considering learning a new method that you ask yourself, why do most retail traders not succeed, so that you can avoid those pitfalls in the beginning. I only focus on what works, but I do think, and I've always been that way, but I think by trial and error, years ago I had to wean out those bad habits. So I do think it's appropriate that we talk about why do most retail traders not succeed. Number one, they don't understand this. Price movement is not predetermined. Most beginning traders think that price movement is predetermined. They think that the market's going to do what it's going to do. I have to figure out which way the market's going to go. Professional trader understands you're never going to figure out which way the market's going to go on a regular enough basis to wager your hard-earned money on that, right? You have to understand price movement is not predetermined. You can get in a trade, but you have to understand that something could happen in the big wide world. Pow, they could stop you out in a hurry, okay? You have to understand that. Anything can happen in the market. Now, that's a lot of cause for concern for most people, but it doesn't have to be, okay? All you need to do is have a good method, place your stop. You have the signal, put the trade on, put the stop on. You can even walk away at that point, okay? But you have to use stops because price movement is not predetermined. What this means is you can have shifts. You can start out the day looking to sell rallies in one market, end the day looking to buy dips in another market. Definitely, you could be starting out looking to sell rallies in the euro, and then you end up looking to buy dips in the Aussie, because you understand that this is a fluid marketplace, that nothing's etched in stone. Price movement is not predetermined. Essentially, it's and looking at the big picture, you can even go so far as to say fate is not predetermined. I mean, you can always make a change. You can always make a positive change that's going to shift you into another view of things, and you're going to make your adjustments. And again, you could start out looking to sell rallies and end up buying dips. So you have to be loose. You have to be fluid. It's not your job to determine where the market's going to go next. It's your job to determine that you're going to follow the market where it goes. Another big reason why retail traders do not succeed is uncertainty is very difficult to process. When you're in a trade, and let's say you're short the euro this morning, and you're thinking, oh, wow, something could happen somewhere where they can have a big rally. And you're going to make yourself crazy with that, right? That's why I say put the trade on, put the stop, walk away. Check back every 15 minutes, or if you're on a 5-minute chart, just come back every 5 minutes on the close and just to see what's going on, okay? Because there's nothing going to happen in between your own ears that's going to really give you a whole lot of help, right? All you can do is wait for what the market does. So uncertainty is difficult to process because people are concerned about they can't see the future. Oh, they want to know the future. But believe me, life's much more interesting when you don't know the future and you have the faith and the calmness to just go along with where the market wants to take you. And, of course, you have your stop in there, too, for those occasional times where you have a big move counter to your position and you exit automatically and you really don't give it any thought, and it's next, you move on to the next trade or the next setup. So, very important, price move. You have to know price move is not predetermined, and uncertainty is difficult to process. You can't worry about the uncertainty. You have to almost embrace it. So there's no doubt about it. You don't know what the market's going to do next, and you better get used to that uncertainty. And this is the biggest one right here. Retail traders do not succeed because they don't understand the importance of using market-generated data only. And what we show you today is market-generated data only. We're only focusing on information that the market itself produced. You know what the only 3 inputs to price are? Well, 4 actually. The only 4 inputs to price are the opening price, the high price, the low price, and the closing price. Those are the only 4 inputs into market-generated data only. The only trading decisions our methodology makes are based on those 4 inputs: the opening price, high price, low price, closing price. Any other input is not going to work for us. Okay, you take that high, low, close price, and we can determine pattern from that. We can determine direction from that. We can determine momentum from that. So what I'm trying to do is I'm trying to wean you making decisions based on something you read or something you fear or something you heard about, and get you to focus on making decisions based on price only. And we'll give you some examples of that. Okay, here's why you came. Here's the $1 million question. How can we help to improve your trade selection? This is critical. As I said, it took me 4 years to come up with that simple method that helps me operate in all environments. One of the most important things I learned along the way is you better know when direction is aligned with price pattern. Very simple observation. Very, very simple observation. And you have to know when direction is aligned with pattern, right? Now, you may not understand when I say you need to know when direction is aligned with pattern. I need to define both direction and pattern. Usually I give you an example right about now, but then I tend to run out of time. So we're just going to stay on point. Before we get to the charts, we're going to stick with the definitions on the PowerPoint. So know when direction is aligned with price pattern. You have to know what defines direction, right? So first we're going to define direction for you, and then we'll look at pattern. Direction is technically change of direction. Because if I'm going to tell you the direction is bullish, I need to go back in time and tell you when it shifted from bearish to bullish. And we all need to be able to go back and see how effective that change is, right? So it's really not direction, it's change of direction that we're focusing on. So change of direction equals a trend line break plus a direction line shift. Trend line break plus a direction line shift. And we'll give you an example of that in a moment. Directional line defined. If I want you to write this down, this is very important. It's a tool many of you have seen if you sat through our webinars in the past. But if this is the first time that you've seen me speak, you want to write this down because this is a fascinating tool. It's how we determine when direction has changed. So you're always going to mark the low of the highest closing candle in an uptrend, and you're always going to mark the high of the lowest closing candle in a downtrend. Very simple stuff. It's outlined in our second book. So write that down. The low of the highest closing candle in an uptrend. Imagine an uptrend, a bunch of green candles. Now focus on the highest closing candle. Not the highest candle, the highest closing candle. The low of that highest closing candle, that's a significant level. Likewise, in a downtrend here, you want to imagine a downtrend, a bunch of red candles cascading lower. Focus on the lowest closing candle, not the low candle, lowest closing candle, and that high of that lowest closing candle. That's a significant level. That's how we help determine direction. And Raul, we'll get to that in a moment. I'll give you examples of it. Directional lines usage, very, very simple. If price is closing below the directional line, the direction is down. If price is closing above the directional line, direction is up. Okay? Here, let me give you an example, then we'll go to the chart. Price reversal equals a trend line shift plus a directional line shift. Very, very important. So this happens to be that green candle you're looking at. That happens to be the highest closing candle. Mark the low of the highest closing candle. So I need two conditions to be fulfilled here. Right here. Whoops. Too fast. Price reversal, trend line shift plus directional line shift. if it closes below the low of the highest closing candle and the trend line, that's a bona fide change of direction. That's a reversal. Likewise, here's my lowest closing candle right here. Not the lowest candle. That's the lowest candle. Here's the lowest closing candle. If you close below both the high and the lowest closing candle, which you did here, and that trend line, then you have a bona fide change of direction, a reversal, essentially. So that's how we define the reversal. Let's go to a real-time chart and show you exactly what we mean. Here's the dollar-yen chart. I'm going to back up my tool. Okay, as everyone see, this happens to be the lowest closing candle of the move, right? That yellow line is essentially my directional line. Okay, I can back it down. Okay, at the time, I'll go back a little further. Okay, see, this is the lowest closing candle of the move. That's the lowest closing candle of the move. So I marked this. We created an indicator to automatically mark the high, the lowest closing candle. Now, you can do this by hand. You don't need the fancy indicator. You can do this by hand. Okay, so that happens to be the lowest closing candle. We've marked the low. Now, this is the new lowest closing candle. It's not going to update until the close of this candle, technically the open of the next candle. So every time we get a new low close, see that was a new low close? On the opening of that next candle, boom, the line moves down. So every time you get a new low close, the line's going to mark the high, the lowest closing candle. If you close above that line, if you close above the high, the lowest closing candle, and you close above the trend line, then you're going to get a reversal, okay? Now, the reversal is really not that big of a deal unless you get it in line with the pattern, okay? And we'll get to pattern first. So right there, that was a significant change of direction right there because it took out, you changed direction and you closed above the trend line. So now it's going to mark the new, it's marking the low of the highest closing candle. Oh, well, now you shift it, you close below that. So once you shift, this is obviously a market where you don't have a lot of pattern to it. You really don't want to be trading this market. All you're seeing is counter trend moves. But that's going to give you the direction. It's going to tell you direction has changed, okay? Now it's moving down. It's marking, this is dollar yen daily chart. It's marking that high, the lowest closing candle. So there you had a change in direction. You had what we call a reversal. So this market's just, there's really not a lot of pattern to it. It's just knocking back and forth. But we're marking that high, the lowest closing candle. Boom, there's a change of direction. Now that may or may not be significant because you had this is also happens to be a higher low right there too. It's still a sloppy pattern. But you're getting the hang of it, right? All it's doing is marking the low of the highest closing candle. So that's direction. Direction shifts lower right there. See that? So all we're doing is telling you what direction is. Now, you're not going to trade every change of direction because, you'll catch some big moves along the way, but you'll get chopped up also. You can see how choppy this is. Now you have a pattern, and there's a higher low, and there's a second higher low. So once you have that higher low, then you may have something. Once you start making higher highs too, same story. So all I do is I have a tool here, and it's marking the low of the highest closing candle. So I know direction. So as long as price is trading above that yellow line, then direction is up, right? Notice when you got that second higher low here, that pattern, you had a higher low here, then you get that second higher low, and then once you took out that high right there, man, you really accelerated. So that was a good case. Short-term pattern was bullish here. So this is a change of direction you want to know about. Right here. When you close above that, boom, on the opening of the next candle, you're going to shift that line. So direction shifted. Direction is now higher. Once if you're above the line, direction's higher. So direction's higher in line with the pattern. So that was a pretty good trade right there. So hopefully you're understanding how that line works. Every time, if we make a new low close here on the opening, if on the close today we close lower than that low, then the line's going to shift down. So currently, direction's down in the yen. So that's a good thing to have. Raul, you didn't write down the definition. Here, I'll go back. Here's the definition. The low of the highest closing candle in an uptrend, the high of the lowest closing candle in a downtrend. You got to know that. So that's all we're showing you. We're showing you how it's very important to mark that low of the highest closing candle because that's telling you direction. Okay? Direction. All I'm doing is defining direction for you. If you once you change direction and you take out a trend line, that's great. And you'll see once you take out that trend line how everything accelerates too. You had a short-term bullish pattern here. You change direction higher. You want to know that. Boom, boom. Now you're cooking with grease there. Currently, though, in dollar yen, direction's down. Still have a bullish pattern, but direction's down. So all I'm doing is I'm not determining where yen's going to go next. I'm not going to guess whether it's going up or down. I'm just telling you that currently on the daily chart, direction is down. So now hopefully this diagram makes a little bit more sense to you where you could see it closed below the low of the highest closing candle right there and it closed above the high of that lowest closing candle right there. It took out both the trend line and the directional line. So if you take out both the trend line and the directional line, then you're going to have a reversal. Now, we're only interested in those reversals that are in line with the pattern, okay? So patterns next. Now, hopefully you know a little bit about direction. If you want to know more about it, Chapter 3 of my last book, Mastering Trade Selection and Management, that defines it, and that'll help you out. So you want to know, we know direction. Now, hopefully you have an idea how to determine direction. Now we need to figure out how to determine price pattern. So price pattern, all we're doing is we're marking the isolated highs on the chart, and we're marking the isolated lows on the chart. And I love this chart because the first time we did a webinar on FX Street, this was the same chart we used, and I have not had to update the chart. Guess what? Price went all the way down here. So it was that simple, knowing that you had a bearish pattern in place. So if you have a long-term bearish pattern in place, you're looking for a change of direction in line with that bearish pattern lower. Here, I'll show you a current chart of the euro US dollar, if I can find one here. And here's how we view the euro US dollar right now. I probably have to go to the weekly to figure it out. There we go. Here, I get rid of all these lines in here. These are short-term day trading lines. But there you can see the pattern's bearish. You have an overall pattern's bearish, and the market's sideways though. When I put on the this is a weekly chart, I'll show you the weekly directional line. Let me turn off the daily and the monthly. There's my weekly directional line is white. You can see the weekly, you're above the low of the highest closing candle, so the direction on the weekly is higher still. So you have the pattern down, but the direction on the weekly is still up. So direction on the weekly up, pattern down, direction on the daily up. So counter trend basically, right? I'm sorry, the weekly pattern's down, but the direction on the weekly chart is up. So nothing to do here. If I drop down to the daily chart, you can see actually that yellow line is the daily guy. Let me get rid of that monthly. And these are actually some pattern lines here. That's my day-to-day pattern lines in there. You can see how tough this market is. Look, you're going to shift that daily higher. So that's actually, that would be a sign to cover shorts. These are all sell signals here, here, here. That's a change of direction in line with a bearish pattern. So short signal here, short signal here, short signal here. But guess what? You're getting run out of there. Now it's telling you you're going to have to come out of that trade. So You gave it you gave it the college try here, getting short in line with the bearish pattern on a change direction on the daily. So you change direction on the daily in line with the weekly, but the big weekly pattern, but the weekly direction is still up. So Euro hanging tough. Euro's still hanging tough. Oops, I'm on a 4-hour chart. Don't mean to confuse you. But you can see you've just been in this big sideways pattern here. I can keep that 4-hour directional line on there. You can see that they changed direction on the 4-hour higher here also. So, you're in a big sideways range here. The pattern, the long-term pattern is bearish, but as long as that weekly pattern is up, and here I'll show you to you again, you're above that weekly directional line. Oops, turn it off. I meant to turn it on. There we go. You see the white line. The white line and the yellow line. The yellow line is the daily directional line. So you're shifting the daily higher, directional line higher, in line with that weekly direction, but counter to the pattern. So this is a tough market. Bottom line, you got to let this guy wear itself out. You got to let this short-term move here that kicked off in August, July, you got to let that guy wear himself out. As long as the weekly direction's up, what can you say? It's hard to go after the short side. So pattern, all important. So currently in the euro, you still have that bearish pattern, but you have to get direction to shift. You need that. It looks like you're going to need that weekly directional shift. Ideally, you get a higher close on the weekly and you raise your weekly directional line up so that it becomes easier to close below it. And here's pattern again. Pattern is so simple. It's so important. If you look at the eyes left here, here's the beauty about pattern. It's scalable. Okay, see those 3 impulse waves up? This is fractal geometry where, people think, well, what happens on the higher time frames gets replicated on the lower time frames. That's true. What happens on the higher time frames is very important for what happens on the lower time frames. However, when we back it up, you can see went a little too far. What happens on these lower time frames is influential on the higher time frames too. That's scalability. It goes both ways. What happens on the lower time frames, you saw that same pattern here, the 1, 2, 3, and then you see that get replicated 1, 2, 3 on the higher time frame. So the beauty of fractal geometry is it is scalable, where what happens on the lower time frames influences the higher time frames also. And of course, what happens on the higher time frames is going to bound or bind what's going to happen on those lower time frames. What happens is in a counter-trending market, you will see price action on the lower time frames move completely independent of the higher time frames. In a trending market, however, price is going to be dependent on the higher time frame movement. But always, higher time frame support and resistance, higher time frame structure will bind lower time frame price action. So you have to know what's going on in the higher time frames. So scalability is cool. Now, but let's get back to what we taught you about change of direction in line with pattern, right? That's a bullish pattern, right? And here's the change of direction. So you're always looking for that change of direction in line with the pattern. Another simple way of saying that is you're looking to buy dips in an uptrend. You're looking to sell rallies in a downtrend. We're always trying to simplify it. So buy dips and uptrends. Essentially, a dip and uptrend is wait for the dip, then wait for a change of direction in line with the pattern. This should be an easier one to spot here because that's definitely a change of direction in line with the pattern because you've already established the pattern at that point. So price pattern, very, very simple. Very, very simple stuff. And here's another example of scalability where here we see the pattern on the higher time frame, that basic zigzag pattern. Now watch, it'll replicate itself on the lower time frame. And then eyes right, it'll give you another replication of it. And that's that basic zigzag pattern. We call that Mandelbrot's generator. Benoit Mandelbrot, the father of fractal geometry, wrote a book on markets called The Misbehavior of Markets. And he theorized that basic zigzag pattern is your basic model of price action. You take that basic model, and when it replicates itself, it creates these complex patterns, which we know to be the euro market, the gold market, the Japanese yen market. And I think there's a lot of validity to Mandelbrot's theory. So it's very important that you understand scalability. Absolutely, scalability. Markets themselves typify scalability. They typify fractal geometry. Now, this is really good news. But what's even better news is that we as individuals are naturally very good at pattern recognition. All trading is pattern recognition. I was reading an article earlier in the year where, Wall Street, they're always trying to look for the next best thing, right? And they tried the macro traders. The macro traders had a good run, but now they're not making money. And the mean reversion traders had their run, and they're not making money. And the quant guys, they come and go. And now Wall Street's latest was, I think they're getting closer, but they're not quite there yet. They're hiring chess masters because chess masters are allegedly good at seeing patterns. The whole problem is they're still trying to anticipate what the market's going to do next. They still haven't hit on the nail on the head, which Bill Williams taught me many years ago. Bill Williams, the author of Trading Chaos, is that all you have to do is go along with where price is going to take you. You're not here to determine what's going to happen next. You're here to determine that all you're here is to determine that you're going to move along with price. Oh, Mike's got a question. Mike, does scaling up make more intuitive sense than scaling down as trend or reversal needs a beginning? You know what? I'm not quite. I'd have to think about that. That's a great question. I think you need to be able to do both, though. But for the most part, you're going to be better served knowing what's going on in the higher time frames. Reversals are extremely rare in trading, and I should put that on the list of why most people lose. They're always looking for reversals. Reversals themselves are pretty rare in trading. Generally, those higher time frames hold. But Mike, I'm sorry, I'd have to give that some thought. Actually, if you could email me that, that's something I'd like to chew on. I'm kind of in the middle here of trying to get in under the deadline here, so that's why I don't have a lot of time to chew on it. But that would take a little bit of thought before I answer that. Scalability, really, really important. And the best part of it is you guys are way better at pattern recognition than you think you are. Computers are still way behind when it comes to pattern recognition. I still think Wall Street's off the mark with hiring chess masters because they're still trying to anticipate what's going to happen rather than just see what's happening now and then go along with it. And Mike, that's what I mean, see what's happening now. Those higher time frame patterns, they tend to hold in place for a long, long time. Patterns overall tend to hold up. Case in point, the euro. The euro's been going sideways for months now. And that's all right. You just got to sit tight. And you got to be a short-term counter-trend trader until it's going to make its move. So you can't anticipate. You can never anticipate in this business. You have to go along with what's happening right now. More times than not, you're just going to see a continuation of that. And speaking of continuation, scalability and repetition. Markets just repeat themselves. Here's the Australian dollar back in March, February, March, and right about in here, you shifted. You had the majority of patterns down. So once you have the majority of patterns down, then you're just looking to sell rallies, right? Then you're just looking to sell. You're going to wait for the trend line break and get short. So you get short, get short, get short, right? Cover on the other trend line break. Cover when it goes the other way. Trade multiple contracts so you can take a profit, put a break-even stop on. Add to it here. Same deal. Take a profit, put a break-even stop on. So you're always protecting your equity, but you're putting yourself in a position where you can catch moves like that, and that. Those are some pretty good moves. And again, it's back to when direction shifts in line with pattern. That's all you need to know. And what are we doing here? All we're doing is selling rallies in a downtrend. Keeping it very, very simple, we're selling rallies in a downtrend. Now, it happens to be that we're taking advantage of the fractal nature of markets also. I tell you what, the one thing you really need to succeed in this business is know that you have the support of a higher being, whatever, a higher conscious, whatever, okay? Whatever you want to call it, you call it a god, whatever. It's true, though. But if you know you have the support of a higher being, you're going to be a lot more confident, right? Well, in trading, from my perspective, literally, if I know I have the support of fractal geometry and I know the power of chaos theory, I basically know that's how the universe works. That's how everything works, scalability, fractal geometry. So I kind of have a big edge because I know that I have that overriding power in my favor. Okay? Now, not to get religious on you, but you could take it a step further. Well, what's behind the design there? Well, we all know. It's going to depend on our own belief system, but it helps tremendously to know that you have a higher power backing you up. And literally, quite literally, when it comes to a method that follows fractal geometry, which follows, of course, chaos theory, that you do know you have that overriding power in your favor, and that definitely favors repetition and scalability. And here's just another slide when direction shifts in line with price pattern. Again, we're selling rallies in a downtrend. And this is the euro. Here's the grand pattern on the euro. Your overall grand pattern in the euro is one of lower highs and lower lows. And here's your primary pattern right there. So your primary pattern, once again, you're getting that breakdown in line with the overall pattern. And again, look at price came all the way down here. But currently, we just have to be patient. Here's where we're at in the euro right now. Here's the weekly euro chart. And, you could be right as rain that this is going to be the top in this market. But until you get that directional shift, what can you do? Nothing. So you have to be patient. Rarely does markets do things on our own time frame. And I come down to the daily chart now, and man, look at how long that market's just sliding out here. And by the way, here I'll show you what these lines are right here. We have a nice confluence of resistance in this market. If I go all the way back to the beginning, the high there, the 2011 high, and I'll put a 382 on there. Boom, look at where the market topped out right on that 382. So I'll mark that 382. That's a pretty significant level. 382 is not significant from a day trader's perspective. All is a very shallow retracement as a day trader, but from a position trader, 382 is a lot bigger number. So there's the 382 retracement. Now I'm coming down. I come down to this peak there, and you're going to see you have a confluence of resistance there. There's 50%, right? Right, that purple line right on the penny, 50%. So not only I have a 382 there, I also have a 50%. So I'll mark that. My 50%, I usually mark that purple. 382 is that high green, and then the 382 is the purple. So you look at that nice confluence of support, resistance right there. Then you come that last high, and there's another Fibonacci number we don't use a lot, but you use it when markets tend to get sloppy and they tend to give larger retracements, and that will be your 764. So you're also right on top of a 764 there too. Look at that. Whoops. Right on top of the 764. So you have a great confluence of resistance right there. It held it, and then you have that big trend line too. So the pattern, the overall primary pattern is bearish. It's down, but you just have to be patient. When you come down to that daily, you can see you're in nothing but a sideways market. And if you don't know to be patient in a sideways market, you can get chopped up. So we just have to be patient, and you have another pattern. Well, you got a 4-hour pattern here that's tough. So that day-to-day pattern, which you're seeing there, I don't have it marked on here, not to be confused with the secondary, which is based on the daily chart. The day-to-day pattern based on the 4-hour chart, here it is. That's tough, so you just have to be patient. Let me get those directional lines out of there for you. That'll confuse you. And there's the pattern that we're focusing on, too, that it just won't go down. It just won't go down. And that's that. So you just have to be patient. As I said, very, very rarely do markets do things on our time frames. That's for sure. Now, one market that I like overall that I think longer term has some potential, although, short term you're turned down here, is dollar yen. I like dollar yen. And when I break dollar yen down, intraday, I could see that I'm balanced here. I take these tradable patterns, 15-minute to weekly, and I take those, and I see the majority of patterns here. They're balanced. You had coming in before that number, you had 4 up, 2 down. Now you're balanced up, 3 up, 3 down. So I don't see a whole lot that grabs me right now from a long-term trader's perspective. That's okay though. There's plenty of opportunities intraday also. So hey, thank you very much, Raul said the very useful information. We certainly appreciate that. And we hope that that you did find the demonstration helpful. If you want to know more about what we're doing at Trading You, just go to our website, Trading-U, and click on Market Commentary. You'll have all kinds of nice videos. You go to our Trading YouTube, our Trading YouTube page, and there's also our Seeking Alpha blog and our Trading You blog. I haven't been writing a lot of stories lately because the market's sideways. I'm not going to write just to write. If you're in a sideways market, you're in a sideways market. You just really have to be patient. And it takes up a lot of time to write articles too. When you trading and teaching takes up plenty of time. So we hope that that this stuff was helpful to you. Here's the website, and here's my information. Here's my email and my Skype. We'd be happy to have you come and view our live market analysis too. If you go to our site, click on Education, you'll find some pretty good trials there too. Here, I'll pull up the trial for you. And thanks for bearing with me. I'll show you the trial where you can come in and you see me calling markets, pointing out setups and signals in live markets. And here's the site. If you go to trading-u.com, go to Education, sign up live market analysis trial, and you can register here for that. And then you can come and see us. You get a 2-week trial. You come in, and we generally extend it to a month too, because we only do it Mondays and Fridays now. So if you don't have time, we understand. So yeah, you go ahead and sign up there. I'm actually in the campus, so I can't show it to you. But yeah, you go to definitely go to Education, and you could sign up, and you could see everything we're doing right there. XAU. Hey, thank you, Derek. I appreciate that. XAU, is that gold you're saying, Raul, or? I'm sorry, am I reading that right? Yeah, gold. Yeah, gold is, here's the gold chart. If we don't have time, it doesn't look like, FX Street's not warning me to wrap it up, so that must mean that there's no one on after us here. So, gold is tricky that, you see a little better on the 4-hour. You're definitely in a buy zone here. You're definitely in a buy zone. Looking at the buy zone held, your day-to-day pattern is still up in gold. And here's how I read it. This hasn't changed any. Unfortunately, if you're long, there's nothing to do here, because if you we call these the 5 tradable patterns, the 15-minute up to the weekly, and you have the majority of them down. Oh, I'm sorry. Those are the S&Ps. My bad. Here we go. Gold futures. Yeah, something was wrong there. Gold's balanced. If you look at the 15-minute up to the weekly, you can see you have 3 patterns up and 3 patterns down. So that's a balanced market. So you're in a balanced market right in your day-to-day here. And you can see how that day-to-day held perfectly. So you hit resistance up here. That's short-term primary resistance. So your shorter-term primary pattern is actually bearish, believe it or not, because you couldn't eclipse that level. And now you see you hit resistance, and now you're right back down to support. So gold, in my estimation, there's nothing to do. And I don't like seeing that, because if there's nothing to do in a market like gold, you can bet that the other markets are going to get quiet. The euro's in a range, stock indices. The S&P 500 is in a range. Gold's neutral. The pound is neutral. So here's the pound. Nothing to do, right? You just take the 15-minute up to the weekly, and in this case, you happen to have a short-term weekly and a normal term. So what do you have? Well, actually, the pound's starting to shift bullish there. Yeah, the pound is actually bullish, which is I have to double-check that. I did not know that. I thought the pound was balanced up. Oh, no, the pound shifted to 15. Yeah, that's right. So the pound shifted to 15 this week. So, yeah, wow, the pounds, you could be working the long side in the pound. Well, the pound's something to trade, but everything else, man, look, the S&Ps are down, but they're stuck in a range. Gold is neutral. So there you go. Well, I guess we'll wrap it up there. Thanks, FX Street. Got a whole hour in, and we managed to get to the presentation, too. Thanks, everyone. Raul, Derek, thank you very much. And, yeah, we'll see you tomorrow when we go over price pattern then. Or I look forward to seeing you guys in some of the trials on the website. Thank you so much.